An American mortgage can freeze a homeowner's rate by moving uncertainty somewhere else. When market rates rise, the old monthly payment can survive for decades. When rates fall, the borrower can often refinance and end the original loan early. That protection is unusual. It is not free. A 2024 IMF comparison found that more than 95% of U.S. mortgages were fixed rate. Australia's fixed rate share fell below 5% in 2025. But the American lender does not need to carry that risk for 30 years. Eligible mortgages can pass through Fannie Mae and Freddie Mac into securities bought worldwide. Their guarantees shift much of the borrower default risk. Interest rate and early repayment risk remain with investors. The payment stays fixed because the risk moves. So where does it finally land? A 30-year fixed-rate mortgage contains an extraordinary promise. The borrower knows the interest rate at closing. If market rates rise 10 years later, the payment does not reprice. If rates fall far enough, a borrower who still qualifies may refinance, pay the transaction costs, and retire the old mortgage early. The homeowner receives payment protection when rates rise and a valuable option when rates fall. Rates rise, keep the loan. Rates fall far enough, replace it. Someone on the opposite side must price that advantage. Imagine a local lender makes a $400,000 mortgage. The lender could keep collecting payments for decades, but then its money would remain tied to one household. Instead, an eligible mortgage can be sold into the secondary mortgage market. The lender receives cash back. That cash can finance another home buyer. The mortgage contract continues. Only its financial destination changes. That ability to recycle lending capacity is one foundation of the American system. Fannie Mae and Freddie Mac sit at the center of that recycling process. Congress created them to provide liquidity and stability to housing finance. They do not normally make mortgages directly to homeowners. They buy qualifying loans from lenders. Those mortgages can then be pooled into mortgage-backed securities, or MBS. An MBS is simply a bond whose cash flows come from thousands of homeowners making mortgage payments. The household payment has become an investable security. The scale is enormous. Fannie Mae reported a guarantee book of about $4.1 trillion in mid-2026. At the end of 2025, it estimated that it backed roughly 24% of outstanding U.S. single-family mortgage debt. Freddie Mac runs a second enormous channel beside it. This is why the 30-year mortgage is not merely a bank product. It is connected to the global bond market. A mortgage contains several different risks. The first is credit risk. The homeowner may stop paying. The second is interest rate risk. Market yields may change after the loan is issued. Fannie Mae and Freddie Mac guarantee timely principal and interest on their qualifying mortgage-backed securities. That substantially shifts credit risk away from the MBS investor, but the investor still owns a long stream of cash flows whose value changes when interest rates move. The risks have been separated. Suppose an investor owns an MBS backed by mortgages near 3%. Then new mortgages begin paying 6%. The older security becomes less attractive. Its market value falls because investors can obtain higher yields elsewhere. The homeowner does nothing. The monthly mortgage payment stays fixed. The loss appears in the market value of the investor's bond. That is the first answer to our question. Rate risk has moved away from the household. Now reverse the direction. Suppose the homeowner has a 6% mortgage, market rates fall sharply, the homeowner refinances into a cheaper loan and repays the old mortgage. That sounds excellent for the MBS investor. The principal comes back, but it arrives precisely when comparable investments now offer lower returns. The investor loses the valuable 6% cash flow earlier than expected. This is prepayment risk. Economically, the American borrower holds a valuable option. When rates rise, the borrower can keep the old financing. When rates fall enough, the borrower can refinance. Federal Reserve research notes that this prepayment option is not free. Its expected cost is incorporated into mortgage pricing. MBS investors, therefore, demand compensation for uncertain repayment timing. The homeowner does not see a separate line labeled prepayment option. It is embedded inside the mortgage rate. This helps explain why mortgage rates do not simply equal Treasury yields. Investors compare MBS with government bonds and other assets. They require compensation for uncertain duration, prepayment behavior, hedging costs, and market conditions. When interest rate volatility rises, prepayment becomes harder to predict. The Federal Reserve has repeatedly linked elevated mortgage-backed security spreads partly to this risk. The 30-year fixed mortgage is stable for the borrower because uncertainty has been moved elsewhere. America also built a specialized market for trading these securities. It is called the to-be-announced market, or TBA market. Investors agree on broad characteristics of mortgage-backed securities before knowing the exact mortgage pools they will receive. Federal Reserve Bank of New York research found that more than 90% of agency MBS trading occurred through this market in its study period. Its liquidity lets lenders lock in prices for mortgages they are still originating. That detail matters. A lender may promise a borrower today's mortgage rate weeks before the home purchase closes. During those weeks, bond yields can move. The lender can use the TBA market to hedge the future mortgage sale. Home buyer receives rate lock. Lender originates mortgage. Fannie Mae or Freddie Mac purchases eligible loans. MBS investor supplies capital. The risk travels through the chain instead of remaining inside one neighborhood bank. This architecture did not emerge naturally from every mortgage market. Before the Great Depression, American mortgages were often much shorter. The Federal Housing Administration says typical loans could require around 50% down, run only 3 to 5 years, and finish with a large balloon payment. That meant borrowers regularly needed new financing. When credit disappeared during the Depression, refinancing became catastrophic. The modern system was partly designed to remove that rollover danger from households. Congress created the Federal Housing Administration in 1934. The FHA insured qualifying mortgages against borrower default. That protection made lenders more willing to extend longer-term, amortizing loans. Fannie Mae followed in 1938 to create a more reliable source of mortgage funding. Instead of every local lender depending entirely on local deposits, mortgages could increasingly connect to national capital. The household received longer certainty. The financing system became broader. The next transformation arrived around 1970. Congress chartered Freddie Mac to expand the secondary market for conventional mortgages. Ginnie Mae had helped establish the government-guaranteed mortgage-backed security market. Fannie Mae and Freddie Mac later made securitization central to conventional housing finance. Instead of one institution carrying one mortgage for 30 years, thousands of mortgages could be pooled and financed by investors across the capital markets. Duration risk became tradable. Other countries solved the same housing problem with different contracts. Canada offers fixed mortgages, but borrowers commonly renew their interest rate after much shorter terms than 30 years. Australia relies heavily on variable rate mortgages. The Reserve Bank of Australia reported that fixed-rate loans were less than 5% of outstanding housing loans in 2025. When the central bank changes rates, many Australian household payments therefore adjust relatively quickly. The risk stays closer to the borrower. Europe shows why most countries use variable mortgages is too simplistic. Mortgage structures vary sharply even inside the euro area. European Central Bank data showed that about 15% of new euro area home loans in April 2026 had floating rates or rates fixed for no more than 1 year. But national differences were enormous. Belgium was near 7%. Estonia was near 98%. There is no universal European mortgage. Denmark provides the most important comparison with America. Danish households can obtain long-term fixed-rate mortgages with prepayment flexibility. But the funding model is different. Mortgage banks issue bonds closely matched to the underlying loans. The financing connection between mortgage and bond is unusually direct. Denmark proves that 30-year protection does not require the exact American structure, but it also proves the deeper rule. Someone must fund and price the long-duration promise. The American model gives households unusually strong protection against rising rates. That matters during inflation shocks. A central bank may raise short-term rates dramatically. New borrowers immediately face more expensive financing, but an existing homeowner with a 3% fixed mortgage can remain largely insulated. The IMF estimates that fixed-rate loans represented more than 95% of outstanding U.S. mortgages in its international comparison. That weakens one channel through which monetary policy reaches household spending. Protection creates friction, too. When market rates rise, the old mortgage becomes economically valuable. Selling the house usually means giving that contract up. Homeowners therefore become less willing to move. The same fixed-rate design that protects household cash flow can reduce housing turnover. So the 30-year mortgage solves one risk while creating another problem. It stabilizes payments, but it can make the housing stock slower to circulate. There is another feature investors cannot ignore. Fannie Mae and Freddie Mac have operated under federal conservatorship since 2008. Treasury entered financial support agreements designed to maintain their positive net worth. Those arrangements remain relevant in 2026. This does not mean taxpayers absorb every movement in mortgage rates. MBS investors still carry interest rate and prepayment risk, but the broader system contains a public backstop around institutions, guaranteeing enormous amounts of mortgage credit. The Federal Reserve has also become a major holder of agency mortgage-backed securities. In May 2026, its portfolio contained roughly $1.96 trillion of MBS. Those holdings originated from monetary policy programs, including interventions during stressed markets. So one answer to who owns America's mortgage rate risk is occasionally the central bank itself. Not exclusively, but on a scale large enough to matter. The mortgage system reaches all the way into monetary policy. The final map is clearer now. The homeowner keeps payment certainty. The originating lender can sell the mortgage and recycle its cash. Fannie Mae, Freddie Mac, or Ginnie Mae can stand behind qualifying securities against credit losses. Investors receive mortgage cash flows and absorb much of the interest rate and prepayment risk. Dealers and derivatives markets help investors hedge that exposure. And during extreme stress, public institutions can become stabilizers. Risk was never eliminated. It was distributed. That distribution has real benefits. American households receive long financing horizons and unusual protection from sudden rate increases. Lenders gain access to capital beyond their own deposits. Investors gain a huge market of mortgage-backed assets. But the structure also depends on government-sponsored institutions, complex hedging markets, and investors willing to hold difficult duration risk. The 30-year fixed mortgage feels simple only because the complexity sits behind the closing document. Return to the mortgage from the opening. One homeowner signs one interest rate that can survive 3 decades. The rate looks frozen. The risk is not. It moves from the mortgage contract to the lender, into a security, through a guarantor, and onto investor balance sheets. Other countries often leave more of that risk with households through shorter resets or variable rates. America built machinery to move it. The real privilege is not 30 years of certainty. It is having a financial system willing to stand on the other side. Follow the money, find the power.